All right. Good morning, everybody. Let's go ahead and get started. Got a long weekend. If you're not in America, you probably have a hard time keeping up with our schedule. But for the rest of you, you know this weekend. Hong Kong down 1%. So we want to take a look at those China ADRs, BABA, Baidu, JD, PDD, XPEV, NEO, those those names. Everything else basically flat. Small caps are up the most. This is more of a dead cat bounce or just a mean reverting reflexive pullback more than any sort of rebounding rally. Still have Fed speakers chipping their teeth today. Uh, don't really have too much on the table. It's more about just getting into the weekend than anything else. There's been a lot of speculation different places about what the move was yesterday. And a lot of consensus seems to be aimed towards good news is bad. And we got, you know, business data yesterday showing that things are fine. And that was attached to the moves that we saw. But if you read the spot gamma founders notes from last night, we don't have the AM edition yet. They pointed out the flows that came in at 1:30. Imagine that on the half hour, no less. The 1:30 flows in the options market that kind of took the legs out from under the market really sent us to the downside. The why really doesn't matter, but when we get to the charts, you'll see that it's not like we haven't given up a lot, really. We're not in negative territory. Uh, this was just a minor pullback, kind of taking some exuberance out of the market. So we are going to get some inflation data or some inflation expectations. It's not really data. And then we're going to go into this 3-day weekend. So what we want to see here is the market hold the line. That's really what we are looking for. Just a stabilization, and you do want to continue to watch those Fed funds. Um, I haven't looked at this yet this morning, but from what I heard, they unwound the September cut that we had seen priced in here. Yep, we can see that now. We're on September. Current rate 5.25. The highest probability of where we will be after FOMC September 18th is still 5.25. That this was pricing in a rate cut that we would be down at 500, and that got unwound. We can see here the current rate. A week ago, it was a 35% chance that we would still have our current rate. And at the time, there was a 50% chance that we would have a rate cut. Now it's a 50% chance that we'll have a rate cut. This number for the cut really hasn't changed very much. It went from 49 to 45 in a week, but the odds of us staying where we are has greatly increased. That's the one that really changed. And really, what they were unwinding yesterday was this 475. if we look at where it was over the last week, it was at 14%. Now it's at 5. So we gained that 10%, you could say. It's one way to look at it. For November, not much of a change on that 500 to 525 number. Just one with the greatest bar here. But we did get a change here on our current rate. A week ago, we were at 22. Now we're sitting at 36. But I would keep my eye on the December numbers. And really, it doesn't hurt to look through the 3 of these. We're just trying to see what the market's doing. Are they pricing in a cut? Are they unwinding a cut that they had already priced in? And, I often use Boeing as an example of when something bad happens, say to a company, or when something bad happens and the market looks at it like, well, this is an event. We can't undo this thing, whatever the thing happened to be. And the market tries to come to terms with it. When Boeing had planes falling out of the sky and was killing entire families of people, it wasn't just negative sentiment on Boeing. They had issues that need to be fixed. This move that we saw yesterday, it didn't come from necessarily an event, right? Plane didn't crash or anything like that. This is all sentiment. That's what moved us yesterday. Somebody lost their warm, fuzzy feeling, the sentiment changed, and the market just hammered it. Okay, that's fine. It doesn't stick. So, don't let that one day negative sentiment turn you into a bear suddenly trying to pile into a bunch of shorts. We could begin moving to the downside and go deeper. We'll look at the charts on that, but that's not our base case argument. Looks like once we get through this last central bank speaker at it'd be 11:30. These time frames are my local time, not Eastern time. Once we get through this person, I think the afternoon's going to be clear. Well, okay, we got the rig count, but I worked on those rigs for most of my life, and the number doesn't change very often. Usually there's plenty of warning if there's something wrong. Say if they come out with a new drill rig and distribute an entire fleet of rigs out there and then have to do some sort of recall that puts all the rigs down. That would be the only thing that would come to mind that would radically alter the number of rigs on the rig count. If you trade oil, though, it's worth paying attention to the rig count numbers just in case. So we'll just back up a little bit until the chart is hiding at yesterday's price. So we talk about how we were positioned for this week, what the expectations were. And I want to bring this up because, it's not always just the patterns that we get on the intraday to trade, right? The whole morning briefing is designed to get us ready for the trading day. Kind of give you some tips and tricks on how you can prepare for the trading day, put your plan together. But part of that plan has to be what kind of day you think we're going to get in the first place. Trend day, sideways day, range day. this whole week, we've been waiting on NVIDIA. That's been the hurry up and wait mode that we've been in. The expectation was that we were going to stay sideways and that we would want to sell into strength and buy into weakness as we wait for NVIDIA, because we weren't expecting to really do anything. So we were using Thursday's high and Friday's low. That was our zone. And I mentioned that you could map this out, plot it to the upside and the downside, lay out 50%, 100%, just in case we did break out, because lower volume means the market could, stretch and run. It's possible. This was what we had to deal with. We were above the 10, the 20, the 50, everything. We had our levels. We could also have used this really big bar here, but that gave us 5,300 basically as the midpoint, that half back. And we already had 5,305 is close enough. There's no reason to tighten it up anymore. And then we had 5,300 as this 10-period moving average. And then we got this. Didn't quite hit the 1.5 to the upside. We cut through 1.5 to the downside. I pointed out, I noticed a lot of people think that price is supposed to stop at these levels on a dime, as if that level is something that price can see, and that it's just going to go there, tag it, touch it, fade away. But these lines give us an idea of where we want to be watching for these price moves and how we want to be looking for liquidity, where it should be at. So this 5,370, when we didn't hit it, is because it was front run, right? Liquidity is on the other side of the pivot. We would expect it to be on this side of the line. But play it out. Say you're long and this is your target, and you're kind of concerned that everybody else is also long and they are also going to use that target. Just to make sure you're not the last one out. Maybe you jump the gun and you think, I'm going to be the first one out. I'm going to go ahead and get out a little bit early. Close is close enough. And so you get out. And you had a pretty good size. And so somebody sees your size getting out and says, well, close is close enough. And somebody else gets out. It's just front running, right? It's deciding that, it got close enough. I think I'm going to go ahead and just take my exit here. And this is why price doesn't always hit a pivot point, right? This is front running. We don't know when there's going to be front running. It's not like I'm sitting here saying you should have anticipated it. Of course not. But you do want to be watching for it on the dome. You want to look to see, are we getting that sort of behavior? Is price getting front run against that pivot point? On the other side down here, we cut through that 50% and went much farther than we should have. If it was just going to tag the 50, get into the liquidity on the other side and then stabilize, it shouldn't have gone deeper, shouldn't have gone that much deeper. So liquidity resides on the other side of the pivot. This went a little farther than I would have expected, but it was still a destination that gave us something to aim for, to target. Once we get to that level, we've always got our ADRs, our measured move from the intraday. There's a lot of other things that we can plot to the downside here that could have given us levels in that 5280, 5275 area. Now that we have yesterday's price, it's done. We can mark out those levels. if we do continue to go to the downside a little bit more, then we have the 111 and the 1236. I would say it's on the table. I've never used one that is that old. When it comes to liquidity gaps, until they're filled, technically it still exists. But the whole thing about a liquidity gap when it comes to order flow is that floor and ceiling concept, right? And when price moves up the dome really fast and it's taking those ceilings out, uh, if it happens really fast, the liquidity vacuum says that the floor is really weak, that there's no structure there, and that price will fall back through those floor levels because of how fast they were made, because of how fast price ripped through that zone. And that's one of the reasons that liquidity gaps work so good. But it's because it happened really fast. If the gap doesn't get closed for any number of reasons, one of the reasons could be because maybe those floors weren't weak after all. Two, that price, after it made the big move, stayed moved long enough for those floors or ceilings, if we had gone down, to strengthen. And now they're not weak anymore because of that. So it's not a gap in a traditional sense where price closes at one level and opens at another, and now there's a gap, and that gap can carry and carry and carry until we fall down and close it. A liquidity gap is the lack of liquidity within a particular zone, which means we can fall through that zone really fast. Is there still a lack of liquidity there after a day, 5 days, a week? I would say it's possible. I wouldn't take it off the table, but I would look for clues in the dome and in the order flow itself to see, is there actually a gap left to fill? Some of the best trade strategies that I use are self-made. I I learned a little bit from different parts and places, and I built myself something. On a question like that, you could build something based on that old liquidity. And of course, there is the shape, right? I like a swing high or a swing low when I'm marking out proximal and distal lines for liquidity, especially when we get like a 3-bar play. And I will carry forward those zones until they get hit. This one that I just marked out from Friday, for an example, when we hit it yesterday. This is a perfect, very great example of a 3-bar play. I shouldn't say it's perfect, but it's a really darn good one. And the follow through, if I was going to use it for textbook examples, it did exactly what it should. I mean, that's wonderful. And perhaps even the one from yesterday that we made, or actually that's Wednesday. This 3-bar is a really good 3-bar. Now, the best 3-bars come with a leg out, right? And that leg out can be a liquidity zone. It can be a liquidity gap, say it that way. So I carry forward that swing low or that swing high, usually attached to a liquidity gap. Would it count for the same thing? So I don't want to discourage you and say that the gap can't be there, but maybe it just wouldn't be a liquidity gap. It would be unfinished business or It would just take us back to the dome, I believe. So we have yesterday's range. If we look at the pivots for the day, we are well underneath the central pivot, the floor pivot. We didn't get to support level 1, which after yesterday's really expansive move, we can see how wide the pivots are for today. They're massive, right? They respond because it's just math. After we get a big day, the market builds a really wide pivot range. And I'm showing it this way first because not everybody has central pivot channels. But if you just have a regular floor pivot indicator, you can open it up and just look at how wide things are. It's not as good as having a central pivot indicator, but it's just another way to show you that you can do these things even if you don't have every single indicator out there. You don't need it. There's always a workaround. But the likelihood that we would fall into an S1 and then maybe rally into an R level or something like that, we're just so far away. They're so wide today that it's hard to believe that we'll hit it easily. Here we are on the intraday. This has 2 pivots on it. One is this really long bar here. That's the weekly pivot. The other one is this very small one here. That's our daily pivot. In the darker yellow, this is our channel for the day, and it's a wide channel. Generally speaking, a wide channel implies that we're not going to have a trend day. A narrow channel implies that we could have a trend day. Now, make no mistake about it, this channel that was narrow yesterday did not cause this move, right? That's not how it works. We use these channels in the morning as a bias to help us try to anticipate what kind of trading day we're going to get. Is this the day where we expect it to break and run, or is this the kind of day where we expect it to hold the line? So when we seen it was a narrow day yesterday, we knew it was possible to be one of those days where we could really expand. This isn't the only tool that gives us that sort of bias either. Spot Gamma has that gamma index. And in the AM notes, if they'll ever get around to posting them this morning, you can look for that every day, and it's just called the gamma index, spot gamma index. I know they love that gamma word. And when it's a -4, it implies that we could expand. And when it's a +4, it implies that we are likely going to be sideways. So that's the range that it uses, from a -4 all the way up to a +4. There's so many different tools that can prepare us for the day that gives us a bias. And if you have 5 things, each independently sourced, that are all saying it's probably a range day, the likelihood of you getting a range day is pretty high, right? It's kind of the whole idea behind it. So this really wide channel implies that today's likely a range day. We are looking at a 3-day weekend, which also usually implies we're going to get a range day, because who wants to get into a bunch of new positions right before a big 3-day weekend? Then there's the big move that we just had yesterday, and we're trying to stabilize and just hold the line. Another reason to believe that we won't have a big day, a big move day. Lack of news, another reason, right? We could just keep stacking them up. There's a lot of reasons to believe that today's just going to hold the line. This pivot is lower than yesterday's pivot, and the channel is completely outside of the previous day's channel. That gives us a bias. Price opened underneath that pivot point and has not yet hit it. So that pivot point now becomes a magnet. Whether or not we turn bullish or bearish today, hitting this pivot is expected. It's what we do 80% of the time anyways. When a market doesn't hit its pivot. It's called an MDP, missed daily pivot. We have one back here. All day that day, we never hit the pivot point, which is the purple line down here. Generally speaking, during that day, the MDP doesn't count. It's the next day when we would look back and say, oh, it didn't hit its pivot yesterday. This isn't my strategy, by the way. I didn't develop the concept of missed daily pivots and how we can use them. You can search for it, though, on YouTube. Just type in missed daily pivots. This guy, Rob, does a really good job of kind of laying out. I think it's Rob. But you can kind of pick up that concept. I don't trade that strategy, by the way, just to point this out. I learn a lot of strategies that I have found to be useful for analysis. So I learned the strategy not to trade the strategy, but just to use it for bias and insight. A missed daily pivot can provide bias and insight. But right now, 5309, that floor pivot, it's kind of the target, like a magnet. We would expect to go there. We would expect to hit it. And we don't have to. Just like back here, we can see where we didn't. It would be the base case argument. Like, what are we going to do today? Beyond anything else, probably hit that pivot point. This is our halfback level. As long as we close below this halfback level, we can't yet get bullish again in the broader market. We have to get back above this level. But then there's also the range that we were in all week. Underneath this 5311 cog line, center of gravity. So we have to get through the cog line. We have to get through this halfback. We also have the Globex open from yesterday. So if we get through the halfback, then we have that Globex open. We have the RTH open of yesterday. And then we have yesterday's high, which is really just a few ticks beyond, and then the Globex high of yesterday. So we do have those levels to the upside. As long as we are above this VWAP level, and you could use just a normal VWAP. I like this one because it starts at midnight, but you could use one that starts at 6 o'clock. Doesn't matter. As long as we're above VWAP, then we want to focus on going to that pivot point that we were talking about. If we break VWAP, then at the very least, we want reciprocation. So however far away we are from VWAP to the upside, we're going to look for that to the downside. There's no reason to measure the levels yet. Like I just measured, I measured it just to show you how to do it. But you don't need to do that until or unless we break VWAP. So if we get under VWAP today, and you at that point want to know what's our next level lower, just look at how far we did go to the upside. Did we finally get to that floor pivot or not? Did we get to this red zone or not? How far from VWAP are we? Measure that distance, plot it to the downside, and that'll give you your downside targets, or at least one of. We already have the Globex low, but this just reaffirmed. All I had to do was measure our distance from VWAP. It's now not just Globex low, but it's also reciprocation. There's that level, and then there's yesterday's low. Then we can continue expansion to the downside. But we also just have in this IB or in our Globex range. Let's just stay away from IB. Or we can just measure this. So we can plot that and lay out 111, 1236. We could lay out our halfback or our 50% beyond that. Gives us even more levels. My base case argument is that we're going to hold the line and go into the close right around that 5,300, which isn't out of line since it's an options level and Spot Gamma's been talking about it as a pinpoint for a while now. Not a surprise. Hey, we're there. $52.80 is the 3-week moving average. I know it's a very small moving average, a 3-day, a 3-week. But there's a moving average concept where you use pairs. Sure, most of us, when we first started trading, heard about the 10-20, the 20-50, the 5,200 moving averages in a pair are the way to go. And each pair kind of has its own purpose. A 3-8 or a 3-10 is no different in its concept than a 10-20 or a 20-50 or a 5,200. I use the 3-8 or the 3-10 for surge, 10-20 for momentum, 20-50 for strength, 5,200 for health. So with the surge, we generally look for crossover. Price crosses the 3 first, then 3 crosses the higher number, whether it's an 8 or a 10. And it could be a bullish surge or a bearish surge, of course, right? Depending on which direction we're going. So yesterday we crossed that 3, but we didn't close below it. It does put it back into play, though, especially if we're going to get like a 3-8 cross. We would need price to get below the 10. We would then need the 3-week to get below the 10-week. If you look at the weekly, we're already working on trying to get back above the 10, depending on which 10 you want to use. I put both of them on there just to confuse everybody and to prove a point. It doesn't matter if you're using the EMA or the SMA, just use the 10, right? So we are firmly back above the 3-week. We're struggling with the 10 and the 10-day. We've got the 0 gamma volatility trigger is over our head. The put wall got rolled up earlier this week, where it was closer yesterday. But even at 5,200, that's closer. We have a market maker move this morning. This tells us that they're hedging, but they're hedging with volume. Now, generally, we get hedging or we get volume. We don't normally get both. That doesn't mean that we can't get both. There's so many different kinds of firms out there. And when I started trading, one thing that drove me crazy is people would say, oh, they are hedging. They are doing this. Who's they? I don't know if you guys, watch Friends or Seinfeld, but I think just about everybody out there's done an episode on they. Who are they? Well, there's too many versions of they out there. There's all kinds of different firms, CTAs and vol control funds, non-discretionary traders. We don't have to know why one group is hedging or why another group is trading. We just need to be able to spot it. All right. So we have the volume of a normal day. 74 is right in the normal range. But we do have the hedging. Now, sometimes this hedging that what we think is hedging isn't. And it could be OPEX, right? That can cause the market maker move signal, even though there isn't a market maker move. So we always want to check. We get the market maker move if the front expiration has a higher implied volatility average than the next expiration out. And we're ignoring that because that was yesterday's. It even says Thursday on it. Thinkorswim is just weird that way. It's still showing it. So if I just roll this up, now we don't see it. The front is at 9.8. The next series out is at 7.3. That shows that the elevated implied volatility average is why we're getting the market maker move. If we think about OPEX, that's the third Friday of the month, and this is not the third Friday of the month, so we know it's not OPEX that's causing it. So they're hedging. Ten-day, 30-minute volume profile with TPO. The TPO is in blue. The volume profile is in green. This is a 30-minute chart looking over 10 days. Throughout the day today and into next week, we're going to slowly lose more candles off of the left side of this chart. Eventually, by Wednesday afternoon, if we haven't broke back down into the 5250 area, then this is very likely what the new profile is going to look like. I had mentioned earlier in the week about this air pocket here, this shallow area, and how we had moved through it so fast, we really didn't leave much of a footprint behind. What happens when we do that is if price was to go back into that area, that it would very likely move right back down through it the same way it went up through it. You can see how we went through it before, almost one time framing. And that's how we came back down through the zone. Okay, perfect. Everything is right on course. The thing is, we didn't get to the bottom. 5250 is the expected stopping point. Instead, we started to consolidate around that area right there, which I know there's a lot of lines on the chart if you're not used to seeing it. This zone is the 70% zone. And so all we did is drop down to the value area low. Either way, now that we're holding in the middle of this shallow area, we're likely to start building it out. We have the point of control overhead that's going to act as a resistance. And we still have this price shelf down here, or volume shelf, what you'd call a high volume node, but I don't like to call it that. It just confuses people. It's large volume level down here that could potentially act as a support level. 53.33 is a cog line, and it's our resistance. 52.50, just for an easier round number, is this high volume node, and that's our support. It's an 80-point range. It's not too bad. There's no discrepancy right now with TPO, by the way. When we evaluate the previous day's profile, we want to look to see if there's a classic shape, like a lowercase b, capital D, capital P. But we also want to look at where the greatest amount of volume was and where the point of control is. And if there was anything left behind that we need to be aware of. This 53.30 that I was just talking about on the 10-day, we can see it's just as relevant from yesterday. So if we do continue to make that move to the upside, this high value area is going to be what you want to focus on, because that'll be the next resistance that we could get into that and get stuck. It will become a little bit of a magnet if we get too close. The problem is, how close is too close? There's really not an answer for that. But one of the things that I like to do when I have a situation like this is just mark this range. It would be no different than capturing an entire day, or doing analysis on like a CPI candle or an event candle. We want to run that zone by itself, mark out our 50% level from that. We can also just analyze that zone itself. It's what I was using yesterday when trading, right? It's still relevant, but the bigger one, this midpoint, lines right up with Wednesday's low. Confluence, right? It's just getting the same answer from a different source. And you can see it, I'm off the mark. I didn't get the wick perfectly. I'm sure I missed it on the bottom too. And it doesn't line up to the tick with yesterday's low or Wednesday's low. I'm not trying to be perfect here, just trying to point out we get our answers from multiple sources to help validate that that's the right answer. So if we can get through this 53.07, then through Wednesday's low, we can get back up into this channel. That channel area is very likely going to shut us down at that point. I think it would be very hard to get through that today without some sort of news. And we don't really have much news left for the week. We got some Fed speakers, so I mean, it's certainly possible. And European central bankers by the end of the day, or no, by 10:30, right? That was the last one. We do have a VPOC. That's close enough. This is a point of control. We just add the V to it because it's untouched. It's an untouched point of control. Think about it from where we closed last night. Since we've opened, we haven't hit it. That makes it untouched. Until we do hit it, we'll leave it on the chart. If you didn't catch when I was zoomed out, there's a lot of untouched levels. These old ones from way back here, they don't have any value because we're in a new contract. But I leave them on there anyways. They're not hurting anything. but really they have a shelf life to them. They're not useful forever. But we'll keep this on here until it gets hit. It's a potential support only from the idea that this is where the greatest amount of volume took place yesterday. Buyer's remorse, trader's remorse. If we go back to this level, you have to have the expectation that there's going to be people who want to trade that level. That's why we would look at it as a potential support, not because it's a key turning point in the market or a place where price has to hold above or anything like that. It's just from the idea that, think about it from your own point of view. If you got in yesterday at that level and you find yourself back there today, you might reevaluate your trade, right? So greatest amount of trading yesterday, if we go back and visit it today, could be a spot where we see it again, the greatest amount of trading. It is worth noting in the pre-market where the greatest amount of volume is. It's up here at the top. And you might say, yeah, okay, but Sig, we've been here for a bit. And, since what, 4 o'clock this morning? But that's where TPO comes in. TPO says we spent the greatest amount of time in Globex last night, right down here at the cog line, 52.92. That's where the greatest amount of time was spent, or the greatest amount of trades took place, and yet the greatest amount of volume is up here. Kind of implies that we ran up into a ceiling. There's a lot of large trades going on up here. They must not have been a whole lot of large buy trades because we didn't continue moving to the upside. It could be just a large pool of liquidity, and buyers weren't able to absorb all of it, so we weren't able to get through it. Could be. We could get, much deeper into analyzing those candles and looking at the volume within each one and really parsing it out. But this isn't the forum for that. But that's the idea, right? We can use that information, get a better idea about how our Globex high was formed, and have a better understanding of what we're going to do with it. This was our range for the week. It was our expected range from last Friday. This is where we were last Friday. We took last week's level and laid it out onto this week. We're going to do the same thing again because we've already got a projection of next week's range. Now, next week's range isn't set in stone yet. The gray line that you see here, that's at the money. It's the current price with a little bit of a lag. As you can see, it didn't shift immediately. But as price is moving up and down, this entire range is moving up and down. At 4:15 tonight, it'll lock into place and then it won't move again. So even though it's not set yet, we can kind of use it. Next week is a short week, 4 days instead of 5. Take our current week's box or our current week's range, and we set it on next week's range. And we can see that next week is wider than our current week. That should give you pause. This week that we just traded was a big unknown because of NVIDIA. There was an expectation of some pretty significant moves. And so we had a reasonably wide range, and it was a 5-day week. What's on the table for next week that's so big that it's bigger than this week, and it's only a 4-day week? That's the question, right? What are they pricing in? Because this range is derived from volatility. If volatility increases, the size of the box is bigger. If volatility decreases, the size of the box is smaller. This range comes from these numbers. This is next Friday right there. 61.63 higher or 61.63 lower. Now, I say it comes from these numbers, but when Mobius built that indicator on Thinkorswim, you can't code it to ask for this. So he had to get these numbers from a different location or get it a different way. But this is what that range is based on. And you can hand draw the lines if you want to. If you're on a broker that isn't Thinkorswim and you don't have that tool, just draw them by hand. Friday after the close, 4:15, come in and whatever that number is, take it to the close and add it, take it to the close and subtract it, and that'll be your high and low for the next week. That's the range. That range is based on volatility. It's kind of the whole point. So when volatility is high, the range is bigger. What is on the table for next week that's so big that a 4-day week has more volatility than the week that we just had? It is worth noting that so far we've stayed inside the box this week. That's nice, considering how many breaches we've had in the last 10 weeks. But the week isn't over. We're still going to be looking at today, asking, are we going to finish the day inside this box or not? It's an 80% probability that we close in the box. But it's been off a little bit, right? Remember, they come in waves. We're still 1.8% above the 10-week, even after that move yesterday. That puts us a little on the low side, all things considered, but here is what we've done for the year and our average distance from 10 since January of this year. We've only had a brief period of time when we were below the 10-week. And while we did run up into 3%, we're a little bit on the fade back. But when I zoom out, you can see that we're not doing anything unusual here. We didn't get overbought. We weren't overstretched. It didn't owe us a pullback. So this isn't any sort of mean reversion logic, right? And for the 10-day rather than the 10-week, we're fighting with it right now. This crisscross above and below. And you can see we don't stay at the 10 for a long period of time. When we look back, we don't see a bunch of these areas where it's really low and it's at the line. We see most clusters where we've expanded one side or the other. There are places where I can point out and say, oh yeah, look, we spent a whole week really close, or we spent 3 days really close. It does happen, but most of the time we just don't stay at the 10 for long. This was a pretty good period of time right there where we stayed really close to the 10. It will act a little bit like gravity now that we are at the 10, since we didn't immediately deflect off of it. We can get tangled up in it a little bit. There's a question, how do I know which things to look at in the morning, sector-wise, or opportunities? This is mark percent change. If you're on a broker that doesn't have the word mark in front of it, just look at percent change. Pre-market percent change. And we are looking at ETFs, ETNs, and indexes. That's what's in this list. So how do I know what to look for in the morning? I look at what the heck is moving in the morning. Now, some analysts use 1%. They'll look at mark change or change percent, and it needs to be greater than 1.0. But I do the morning briefing with you guys early enough in the morning that 1% is just too big of a number. So for the morning briefing, I use 0.5%. If you're doing the briefing closer to 9:30, right? And I do these to teach you guys how to do your own. So you want to work through these steps on your own. If you're doing your own pre-market plan and it's closer to 9:30, use at least a 1.0%. So what's up on the morning, what's down on the morning, at least 0.5%. Semiconductors, the Mag 7, gold miners, more semiconductors, we got solar, Bitcoin, more miners, and FANGs again. So that's what we have up this morning. Things that are down. Nat gas down 3%. Well, that's a nice kick in the face. And the VIX is down. I would just discount that. The China ADRs through KWeb is down, but not enough. Remember, 0.5% is our benchmark number. We're not even there yet. Now, different brokers have different issues with pre-market. Thinkorswim is no different than a lot of the others. It is not necessarily your best pre-market tool. TradingView does a reasonably decent job with pre-market material, and so does TrendSpider. I always come back to TrendSpider when it comes to pre-market. And really, what I'm referring to there is seeing pre-market price on a daily chart. TrendSpider shows it. TradingView will at least give you a line, right? It'll at least give you some line that says, you know, right there, the pre-market. And so if we're gapped up or gapped down, you can at least see it on the daily. But on Thinkorswim, you could be looking at a daily chart at something that is up and you won't see anything, right? You'll have to look at the bid and the ask versus the last and see, are we up, are we not up? Because the daily chart won't show you that move until the 9:30 open. So just get used to that, right? So what do we got this morning? Pot stocks, gold miners, precious metals through silver and semiconductors. That's what's up this morning in the pre-market, and small caps, the indexes. Things that are down, nat gas, cloud computing, but be careful with that one. A lot of times it's just an algo print. We're not looking at any real flows this morning in cloud. And then DBA, also just a print. We're not really seeing any flow here. Jets are down this morning. Also just a print. We're not seeing any flows. It's not a surprise that we're not really seeing much movement to the downside. We already just seen a really good move to the downside. But hopefully throughout this morning briefing today, I've highlighted we're still in the week's range. We haven't gone anywhere. This market didn't have a massive sell-off. It was more of the speed of the move yesterday than it was the distance that we moved yesterday that I think is messing with people. We have a lot of things this morning that are up, just a little bit of a rebound, honestly, you know, like a dead cat bounce kind of move. We don't know if it's going to continue until we break yesterday's low and continue to go lower. And we don't know if we're going to come back up until we break the half back and go higher. We're in this nice, clean little channel. And until that changes, you can play the channel or just prepare to play the move when we get it. Everybody, I hope you have a good weekend. Enjoy the 3-day with the family, and I will see you all next week.